All right, there we go. Perfect. Welcome, guys, once again to today's class. Today we'll be doing dividend tax at an advanced level. All right, so we start with the legislation. So the legislation actually gives you an outline, of the definitions of what a dividend is and also what is defined as a contributed sorry, tax capital. Yes, you just need to know that. So also you need also to know the paragraph A, K of the definition of a gross income, what is gross income, yes, and all that. But also you also, of course, have got to understand your section 10(1)K, which is the exemption relating to dividends, you see, and also your provisions in that regard. Your section 10K, double A, which relate to the receipts, then all that, and also your 23F, expenditure to produce exempt income, which is also not deductible, meaning which if you incur any expenditure where you will actually get dividends, because dividends themselves actually, dividend itself, perhaps it's actually exempt, so you cannot therefore deduct that expenditure. Section 25WB, you don't really have to know this section and all that. But also you've got then to understand, about your paragraph 1975, 7475 on 8th schedule. We all know by now 8th schedule deals with capital gains tax. Okay. All right, guys, these are just the fundamental principles. What happens with dividend, you've got to include it in your gross income. You see, in the definition of when you talk about your gross income, you include the dividend. Therefore, then local dividends from South Africa are exempt in terms of your section 10(1)K. Your foreign dividends also enjoy full exemption. In terms, may enjoy full exemption in specified circumstances. Also 10(B)(2), and also your partial exemption on 10 capital P3. But also these, of course, exclude the dividends that you see deemed dividends that are determined in 31. Also some dividends tax in a dividend received from South African companies at a flat rate of 20%. Gross value. So this is what you know. So what's applicable, what's the rate is 20%. Then where the receipt, of course, is exempt from tax on non-resident, the rate may be 0 or rate lower than the statutory rate. So it just depends on that circumstances. Okay, so what is the dividend? It's always important to just go back, get to understand, get the definition. For example, they say here an amount transferred or applied by a company that is a residence for the benefit or on behalf of any person in respect of any share of that company, whether that amount is applied or transferred by way of distribution or a consideration for the acquisition of shares in that company. Sometimes, remember, guys, sometimes when they say you assume to have acquired shares in a company, but it's kind of a dividend, in that case. So it can also be that case. I know in accounting, when they talk about dividend, they talk about distribution other than use to equity participants. So when they talk about those things, they refer to a dividend. But in text, of course, this is the definition that you see you've got to know. But remember, guys, I mean, like, really at this level, I don't think, in fact, you have to worry really about the definition. No one is going to say define definition of dividend. No, it's not going to happen. So an amount, so we don't have an amount, so it's not defined in the Income Tax Act. So it cannot be cash, so it can be anything, of course, but it has to be monetary value. You see what you're referring to. It includes, of course, any value. You can see on push-up bros and also a Primaria Renaissance case. So sometimes also a transfer of property with a value. Sometimes they say then it can be corporeal and incorporeal. Then this will be a dividend in specie. That is what they refer to. So what does transferred mean? So it does not have to be transferred sometimes just granting a relief of a debt owed by shareholder. You see, then it would be applicable also. You see, it can also be deemed as a dividend. So in these cases, you can see and understand there is not necessarily a transfer. However, there is just a granting or maybe a relief or a waiver of a debt. So what is a residence? So they define a residence as a company which is incorporated in the country, maybe established or formed in a country, and it have its place of effective management in South Africa, of course, unless exclusive resident of another country in terms of a double tax agreement. So it will depend in that case, of which then the distribution by entities then included in definition of a company. It falls under that. Also, the company must be South African resident, very important. But for the benefit, of course, or in behalf of any person, in respect of a share of that company, meaning which a person, there must be a causal relationship between, the distribution or a transfer and a person holding a share. You see, there must be indirect or direct, to that transfer, which of course, the transfer then is a consequence of holding, of that, of a share by that person. So distribution then of shares, to connected, is connected connection between shareholder. You see, it cannot be a legal holder, but in the company. So I mean, we must be a shareholder, and the company, of course, there must be a person having a right towards the company. Then the company is distributing, this dividend to this person. Your casual causal relationship can be found on a Stevenson versus Cesar's case, which is Commissioner of Sales Revenue. So transfer of an amount also by a company should be connected to shares held in the company. As you can see, they are trying to, to establish a little bit of that causal link. Yes, and as you can see here, when they define a share, they say that any unit into which the proprietor interest in that company is divided. Remember, there are people that actually own shares and in units in different terms, those people, then that's a share actually in that company. So you are getting a share because you are a shareholder. That's why. So what does the word shareholder means? It means you are holding a share. Actually, you have a proprietor interest in that company. So events of transfer, of course, going concern distribution. So the company is going concern. Sometimes the company is liquidated. So sometimes we've come to the end of the road, unfortunately. So you guys, because you do have shares, you've got what's left in the company. Let's get it distributed amongst ourselves. Redemption, sometimes cancellation or share buyback. Sometimes the company is just buying back the shares. Sometimes the company says, this is what happens when sometimes the company has so much money actually, so many retained earnings sometimes, then they take a decision, say, you know what? Let's just give back the money to people. What do? We're buying back shares. So they say to you, oh, look, Masibulele, actually, we know you have 5 shares in this company. We want to buy them back. But what they will do, sometimes you find out that I paid 20 rands for these shares. However, they are giving me 30 rands. So what does this mean in that case? It means there is a portion which may be dividend in that case, but at the same time, there is CTC, which is a contributed tax capital. Of course, they speak of specific exclusions. So one, reduction on the company's contributed tax capital, returns of capital. As I said to you guys, sometimes it's a return of capital to me. So you look at it. So sometimes they will give you a transaction and say to you, look at this transaction of 100,000 shares, 50% of it was CTC. So that means in that case, that's not a dividend. So you've got, of course, to understand. So it's actually any amount transferred constitute shares in the company, no outflow of value or of form of dividends or capitalization shares back. But of course, not all of them are general repurchase. Sometimes, yes, so you just have to understand then there is a specific exclusions in a test. Let's look at this definition of dividend, you see, with a close eye. Let's just talk about this decision 3. So they say sometimes you ask yourself a question: did a rest and company transfer or apply an amount to or for the benefit of a person? You ask yourself that question. If your answer is yes, you go on again. You say, was the amount transferred or applied in respect of the share in a company? If you find yourself in a yes direction, you've got to go again. But if you find yourself in a no direction, you take another direction and you carry on. Then you ask yourself, did the amount so transferred or applied result in a reduction of contributed tax capital? Remember, the contributed tax is a capital that you contributed within a company, maybe initial when you initially bought this share. So is that the case? Or does it constitute a share in a company or constitute a general buyback of shares in a listed company? If your answer is no, the amount constitute a dividend. But if your answer is yes, the amount does not constitute a dividend. So you are not talking about a dividend in that case.
Okay.
Hello, guys. I'm sorry. I think my network is failing me. All right, let's get on, guys. We're actually doing this example. So what were we saying? I don't know now. I don't know why, the network is not so good. I don't understand. Okay, it's fine anyway. Let's get on, guys, and hope for the best. Okay. So we've got a class example. So what are we saying on 3rd of March, 2022, SACO Ltd, actually a company, a resident company, paid a dividend of 2 rands per share to its 500 shareholders for equity shares, as well as 12% preference dividend to its shareholders of preference shares. It is the dividend as amount are transferred to for the benefit of person in respect of shares. Okay, so that is actually, so in this case we can see these are actually dividend because these people are shareholders. They are holding shares in a company. We've got another example on 1st of November. BDO was liquidated and distributed 2 million, of which 100,000 represented contributed tax capital. So in this case, guys, as I said to you, it's not a dividend if it constitute, a CTC. So for example, in this case, it's only 1.9 that is a dividend, and 100,000 is not a dividend because it's a reduction of contributed tax capital. On 1st December, then STC acquired 10% of its equity shares capital in terms of the share buyback. So in this case, the share buyback. It paid the shareholders 500,000, of which 100,000 represent contributed tax capital. As you can see then in that case, that 100,000 does not constitute a dividend. So 400 is dividend as 100,000 represent a reduction. So the share buyback exclusion doesn't apply as it is not a general repurchase on the JSE. So you need to look now at the wording. Is the general repurchase? If that's not the case, then it doesn't apply. On 1st October, CDV Ltd acquired 15% of its equity shares, share capital in terms of general repurchase. Now, in this case, can you see this? This is a general repurchase of securities of JSE. So CDV pay the shareholders 400,000, of which in that case, 100,000 represented CTC. Remember, CTC, it doesn't constitute a dividend, because it's a reduction. So none of the 400 is a dividend as it is a general repurchase. So guys, these are two instances, and believe me, it is actually a very interesting, scenario if, we're in a question where we, because you've got these two instances, and if you want to trick students, you just want to understand, do they understand the difference between these two? It's so easy to throw this to them. Okay, on 2nd of February, let's look at that again. On 2nd of February, what do we have here? So FDM Ltd resident company paid an amount of 700,000 at the instance of the sole shareholder to his wife. At the instance, remember, at an instance of the shareholder is instructed that they pay the amount to him. So 700 is a dividend since it is an amount applied for the benefit of a person in respect and the holding of a share within a dividend basics. So on 18th organization shares to its shareholders, the shares were valued at a current market value of 8.7 per share, and 1 million shares were issued. So you can see it's 8.7 million. The amount of 8.7 then was financed by transfer from retained earnings to share capital. So in this case, capitalization to its shareholders. So the share issue is not a dividend as it comprises of shares in the company. So there is exclusion actually under paragraph B2. So as you can see in this case, it was issue capitalization shares to its shareholders. See, so it's a capitalization issue. As you can see in this case, there was no distribution actually, but it was a capitalization issue. So people were actually given more shares actually in a company, and they were kind of trying to distribute the amount they had so much in their retained earnings. Actually, they just moved that to their still within equity, but it just moved now to in capital actually, yes, ordinary shares or something. Contributed tax capital, this is what we've been talking about, saying this is a theoretical term, of course, of amount derived from contribution made to a company as a consideration for issue of shares. So when the company issued shares before, they actually paid 20 rands per share. But now they're saying, no, look, we are giving you back 500,000. However, 50,000 of it is a contributed tax capital. So it's a reduction, meaning which that one is the amount I contributed when I purchased the share. So this is why they say then is worked out separately for each share of class, so it can be different. Also, in case you need to compute this in foreign, so what you need to do, the market value of shares immediately before the company becomes a resident, this is case of an unresident. You add consideration for fresh of shares in case there was new fresh of shares. Then you add, of course, consideration received for converted shares. Remember, if it's a foreign company, you might be converting shares. You less any amounts transferred to shareholders determined to be citizen. That's why they say if there is an amount transferred to shareholders determined as CTC, you've got to deduct that because that doesn't form part of your capital now because there has been a reduction through CTC. You less any CTC in respect of shares that have been converted, then CTC for the class of shares. So in the case of another company, the stated of shares, capital and share premium of a class of shares immediately before 1st 2011. So you should know one thing. Before, there was something called share premium. Now there's a par value. So meaning which there is no longer share premium. So they used to say when you buy a share, the share is 1 rand 50. 50 rand goes to share premium. So they were actually dividing. A lot of you guys that did accounting, you see FAPEC, they know you had then to divide to have your share premium separate than your capital in that case. So less so much of the stated capital or share capital and share premium that would have been a dividend as defined, but had the stated capital was a share. But you see, in your case, guys, I don't think there is a question that can go as far as 2011 and all this, but it's important for you guys to know. You add consideration for new shares, add consideration for shares received if you convert the shares, also less any CTC, then you'd have the CTC for the class of shares. What does this CTC mean? It just means the number of shares, actually the number of capital there. How much is the CTC? Contributed tax capital. But remember, in case you have another one that have been, because remember when I gave you an example that, sorry, I'm getting a dividend of 500,000. However, they are saying to me, look, Mr. Person, out of that 500,000, actually 100,000 is a decrease to your contributed tax capital. It means now the share capital of that company, if before it was 1 million, now it's no longer 1 million because there was actually a reduction that has been given to me of 100,000. Untainted shares, okay. Untainted shares, so share capital after taking into account, of course, capitalization issue, we need to know which goes to a dividend if distribution to shareholders. Should it
Jay. Ela. Ingephela njani? Hayi ngihambe kahle. Ngihambe kahle Jayce. Hey, angazi.
So guys, once again, tried to connect now to another device. Just don't get it. I don't understand why must the network be doing this to us. I don't know. Okay, guys, let's just carry on. Okay. So we're actually talking about the CTC. So we're saying contributed tax capital. So we're saying then is a tax concept is a tax concept unrelated to any accounting or company law treatment. So if a company could elect to reduce its CTC yet for accounting purposes, pay the amount out of profit. Conversely, a payment out of the company's share premium account for accounting purposes will not represent a reduction of its CTC unless the directors elect that company's CTC be reduced by an equivalent amount. And also a company's CTC cannot become a negative figure, in which you cannot have a negative figure now. Once the CTC is reduced to nil, any further payment to shareholders will represent a dividend because the transfer cannot be determined to be an amount of CTC because the CTC is zero now, meaning which the contribution to the company. All right, we've got an example with us here. On the 1st of Jan 2011, GP stated capital was 200,000 ordinary shares of 2 rands each. Now we can tell how many, it was actually 100,000 shares. No, it's 400,000 actually in total. So on 17 March 2012, it issued 60,000 convertible preference shares at 4 rand each. On 1st Sept 2022, it distributed 20,000 to its ordinary shareholders, and the director that the distribution was a distribution of CTC. Now, as you can see, CTC has been reduced by 20,000. So if someone's asking, so please, guys, please mute yourselves. We're in class. Guys, please mute yourselves. Slungile, please. Okay, I've tried to mute him. Let's hope he's muted. Okay. Slungile, please behave yourself. All right. So required, what is the amount of GDP after the above event? So you need to know what happened actually. So we had 200,000 ordinary shares at 2 rand each. So now if we deduct 20,000 out of that, how much is the CTC left? It should be 180,000. So if the preference shareholders of GP decide to convert 5,000 shares into ordinary shares on first, what is the amount of CTC? So it means in that case, if we had so as we can see, this all happens in 1 March 2022, with additional 60,000 shares at 4 rand, which is 60 times 4, which is it will be how much? It will be 60 times 4, 240,000. So you had 400,000 plus 240,000. But what happens on 1st September 2022? But remember, that conversion only happens on 1st of March 2023. So it means you will have your 400,000 less 20,000, you've got 180,000 as your CTC. Then immediately when they convert now on 1st of March 2023, it will be your 240 plus 180,000. So they say 400, yes, 400,000 minus CTC 20,000, you've got 130, then that's part 1, then part 2, then you'll have your CTC as per above, then at consideration converted, if they convert that. Is it, let me look at the number of shares now. Or it was actually, Oh, they are converting. Oh, yes, they only convert. Look at the required number 2. They only convert 5,000 of that. That's why they're saying they need to be 5,000 times, which is 20,000 then, the ordinary shares. Then the preference shares then will have to decrease in their record. Another example, on 1st May 2007, DM Ltd issued a capitalization share ordinary for every 2 ordinary share held. Prior to the capitalization issue, equity capital consisted of 200,000. So it was 200,000 1 rand share and 20,000 of share premium. So in this case, the share premium, which was actually 220 in total. So in settling the capitalization share, the company applied 90,000 of its retained earnings and 10,000 of its share premium. Now let's read here. So provide the journal entry to record the capitalization issue. So we need to record the capitalization issue. So what is the capitalization issue? So they actually applied 90,000 of its retained earnings and 10,000 of its share premium. So the share premium is reducing now from 20,000 to 10,000, actually meaning which it's 100,000. They apply this capitalization issue. So this capitalization issue is just that it's not clear whether is it 1 share, is it guys, please, guys, mute yourselves. Abani, please mute yourself, please. It's very important. Thank you. Okay, compute a balance of share capital and share premium after the capitalization issue. Assume the balance computed in required to above are the same as 1 January, determine the CTC. That's all for 7 marks. Let's see what they say here. So you'll have to have the journal entries. So in this case, as you can see, you're having share capital, debit share premium, debit retained earnings, credit share capital. Why is that the case? Because remember, our share premium is an equity account. So it's increasing in credit side. So now because it's decreasing on debit side. Also retained earnings actually increases on credit side, now is decreasing. However, this is a capitalization issue. So I mean, it's actually increasing what our share capital, 400,000. Also remember, guys, I can be very excited. And if I am excited, I can come with journals. So meaning which you people can also be required to come with the journal entries. It's very important for you to understand the journal entries. Okay. Now, part 2. What does part 2 say? They say here, compute the balance of share capital and share premium after the capitalization issue. So it means your share premium, now as I said to you, your share premium must have reduced. So you've got ordinary shares of 200,000, you had additional of 100,000. How much do you have? You have your final of 200,000. In your share premium, it was 20,000. You reduce it by 10,000. Why? Because if you come back here in this example, if you come back to this example here, they say to you here, this is what they are saying. They say to you here, 10,000 of its share premium. So the share premium actually was 20,000. So there is a reduction. That's why you see now the new ordinary shares is actually 90,000 plus 10,000, which make out what? 100,000. So in this case, as you can see now, you've got then your share premium here reduced by then the total. Yes. Part 3, let's look at part 3. So they say, assuming the balance computed in above as the same as at 1st January, determine the CTC on 1st January. Let's look here again. So here they say the share premium, share capital and share premium will be 300,000. You less your retained debt, which is your capitalization, is 90,000. The contributed tax capital in that case will be 220. Your 220 meaning what does this mean? It means they did not use, then in this case, the share premium to reduce that. Okay, let's read again about this. The transfer, which is equal, limited to the available balance. We said that it cannot go beyond that. If you've got your contributed tax capital, it cannot go beyond that, it's limited to that balance. Also, the transfer then of the balance represent a return of capital for the shareholder, which will reduce, the company's CTC. Limitations, of course, transfer to each shareholder cannot exceed the total amount of class shares. So it cannot exceed the class of shares contributed. So then we've got 2 again. So common distribution, which is equal to the amount of CTC to each share in that class, and also consideration for acquisition, cancellation, redemption, paid or payable by company, where the company transferred an equal amount to what? To each share class. Remember. So what do they mean? They mean in this case, we talk about the share class. There can be different class of shares within a company. So we look at different class of shares. You cannot apply it across. As you can see, a total number of shares of that class. You can see. So we say number of shares of that class held by the shareholder, total number of that shares of that class. So amount of CTC, which is contributed tax capital reduction. So we deemed amount which bears the total cost, the same ratio then as the amount of shares. So we've got an example here. Let's look at this example. We've got Jane here and Payne there too, of course. The only shareholders hold 40% each in company C, Pty Ltd. On 20 February. The directors resolved to pay out to the share premium account an amount of 6,000 to Jane. So in this case, you've got share capital, then share premium, 7,900, then you've got cash. So determine the CTC and the CTC reduction before and after payment. So the share capital here was what? You can see it was just 100 Rand. So their contribution here was just 100 Rand, as you can see. So that's before, that's contributed tax capital before. So if they determine CTC and the amount of CTC reduction before and after the payment. So the CTC is 100 Rand. After the payment, what happens? The CTC is also 100 Rand. It means it will be zero. You cannot go over and above the balance of the CTC. Let's look here. So we've got here CTC 8. Let's look. Let's go back here. So here we've got what we've got. Share capital. This is a balance sheet. Share capital 100 Rands. Then share premium, in this case, yes. Okay, let's see. So if CTC, because if they say CTC is 8,000, will that mean, that may mean they are also actually including also share premium. Let's see. So they're saying a CTC is actually 40, let's say, amount of CTC reduction, 40 over 80 times 8,000, which is for their 40,000, is a dividend of the company. 6,000 out of, they will deduct actually the 2,000. Let's just see what does it mean. Oh, I see now. Because we are talking about 40%. So how much is actually held by these people out of that total? So they come here then and see CTC is 8,000. Where does this 8,000 come from? I think this is the case. So this amount, we've got 8,000 in this regard. Then they say, then it's only 40 over 80. So why are they saying 40 over 80 here, guys? 40 over 80. Why are they saying 40 over 80? 40 over 80 because these guys, they are the only shareholders, and they're 40 shares each in a company. So 40 shares each in a company, so which is equals to 18. So then after the payment, then it would be 8,000 minus 4,000. Then the new balance, of course, now will be share capital also. Then they've got these new balances here. Capitalization. So capitalization of profits. So share issues to existing shareholders at nil. CGT effect, we need to talk about that, and also any CGC effect. But these are not dividend as defined. Share buybacks. What are share buybacks? We did say, is the general share buyback or is the specific share buyback? When a company reduces its share capital or it acquires its own shares from its shareholders, it writes off the amount of shares acquired against its share capital. Meaning which if the share capital before was 100,000, then they bought back shares to the amount of 100,000 or 50,000. The new share capital will be 50,000. So it writes off then the amount of share acquired against its share capital, the share premium or reserves. So para B, of course, includes the share buyback in definition of a dividend, except to the extent that it results in a reduction of CTC or it's a buyback of South African listed company. Now you need to know, is the South African listed company buying its own shares in terms of certain JSE listing requirements, unless that's the case. So any payment in excess of the CTC out of the reserve by the company to the shareholders, then it would constitute a dividend, as it is not or does not constitute a CTC. But you need to know that also asset may be paid a consideration for share buyback also this would result in a dividend. We just need to know then if this is an asset, that will be a dividend in space distribution. So yes, that's what happens, yes. Share buybacks example, we've got APTY Ltd. They had 20,000 shares of 2 rands each, and the shares were held equally by Mr. Stephen and Mr. Smith. The company resolved to buy back the shares from Mr. Smith of 30,000. So they had 20,000 shares, right, of 22 rand each. As you can see, that's 40,000. So these shares are equally, so it meaning which how much each person, 20,000 shares, 2 rand each, the shares were held equally. So meaning which is 10,000 shares, 10,000 shares at 2 rand each, that's 20,000. But the government resolved to buy back the shares from Mr. Smith for 30,000. Now, Mr. Smith, how much was the contributed capital by Mr. Smith in this case? He contributed only 20,000 because the shares were, if they are equally shared, actually, it means he had 10,000 shares at 2 rand, which is 20 rands. But they are paying these shares at 30,000. So you'll have the debit share capital of 20,000 because they are buying back the shares, 20,000, which is only 10,000, of course, from Mr. Smith. Then you've got the revenue in this case. Then they are doing that in shares. So the reduction of share capital is not a dividend, which is 20,000. And also, but the 10,000 revenue reduction is a dividend, which is on top of that. It's more than the contributed tax capital. Another example, in special distribution, ABCPTY had share capital of 20,000, 2 rands in the company held 75% by Mr. A and 25% by Mr. G. The company resolved to buy back all the shares of Mr. G by distribution and asset with a book value of 50,000. Now, this isn't a dividend in specie, but a market value of 70,000. The book value, so the journal entries passed to reduce, or was actually this one. Debit share capital, 10,000, which is 25% of that one. So then also then they say debit revenue, 40,000, then credit asset. Why the asset they're actually using the book value. So determine any normal tax dividends, tax and CGT implications for the above. Remember, there might be CGT because now we're talking about the asset in this case. So as you can see here, so amount transferred to the shareholder, market value. So we don't use, actually we use market value here. You can see here, what do we have here? We've got 50,000. It's a book value, this one. It's a book value. However, the market value of this asset actually is 70,000. So we look here, we're saying how much is transferred to the person at a book value, at a market value is 70,000, less reduction, which is the CTC. Where is this CTC? Because the person actually, it was 10,000 of the contribution. If you calculate 25% of 20,000 shares here, multiply by 2 rand is 10,000. Then you've got less than dividend, then is 60,000. So dividend tax is 20,000, then which is payable by the company. Guys, please tell me, why is this dividend payable by the company, by not the shareholder? Why? Because it is a dividend in specie. A dividend in specie, the company pays the dividend tax. The company will also have a recoupment in terms of the A4 for any allowances claimed on the asset. They'll have to recoup it, add it back to the taxable income. The company also have a capital gains in terms of section is a capital gains. So we'll talk about the base cost, then also calculate what capital gains. Now, guys, can you see in a question, actually this question, a dividend tax question can be integrated. And look at this integration, a very nice and interesting integration here, where you've got distribution, you've got CTC, you've got, all these things dividend in specie. Look here, you've got your recoupment, and also what do you have? You have got your HQ, capital gains tax. So the examiners, can be so excited, can actually go as far as this. So you guys, when you revise, you are expected, to think about these things and also to explore what are possible questions, what are possible integration within this topic. Further principles also is increased by consideration received by our accrued to a company for issue of shares. In case there are new shares, will also, because I will not only include cash, but also can include
Sorry, sir.
asset. Yes, okay.
Doctor. I have a question.
Yes, okay.
So, aren't all dividends that are paid by the company taxed by the company and not in the hands of the person that those dividends accrue to.
Yes, okay. No, you see, Meneria. Okay, let me just explain this. What happens if the dividend is given to you? It's actually taxed in your hands. It's just that the company has an obligation. It's a withholding. They have to withhold the money and pay it over to SARS. It's the company. But you are the one that pays the dividend. Let's say, for example, the company issues a dividend of 100,000 to you. It's a normal dividend. It's not a dividend in specie. If it's not a dividend in specie, it's not a distribution of an asset or something, it will be a normal dividend. So company will have to give you only 80,000. Then they will take 20,000 to what to SARS. They have an obligation to do that. However, if it's a dividend in specie, it will be the company. The company, for example, in this case, the company gave 70,000. So they have to pay dividend tax themselves, the company. Is payable by the company, not by you, because it's a dividend in specie. Only in a dividend in specie or in a specie dividend where the company pays the dividend tax, not you.
Okay.
Yes.
Thanks.
So they said then in this case, it is increased by consideration received or by or accrued to the company for issue of shares. If there are new shares, we know our capital, share capital contributed will increase. The cost will not only include cash, but also maybe an asset. Sometimes you are just giving your asset to the company. That's also CTC. So in the case of service, the value of the service rendered, sometimes you are rendering a service to the company. That may also be another contributed tax capital. In the case of asset, the market value of such asset, we include the market value as what? As a new value of CTC. For we've got an example of Mr. B, he acquires 100 shares and settles the payment by transferring an asset with an amount of 120, but which was acquired for 80 years. The CTC is what? Is 120. Why? Because we use what? The market value. They are very clear here. They say in case it's an asset, what do we use? We use market value. Market value. So in this case, you use market value, so which is 120. So the directors must make a determination of the contributed tax capital for each shareholder. So in order to reduce, they need to know how much each shareholder contributed in case they want to reduce in the future, in case they transfer monies of which they deem the transfer to be the reduction in CTC. Capital gains implications, yes, there can be, capital gains implications, distribution of an asset in specie, that's what we're talking about, or repayment of shareholders' capital gain or loss. So it's not a distribution of cash, but not an asset is defined, you see. Yes. So it's not a distribution of asset, but not an asset. So section 1, let's just read this. The return of capital defined, so it's an amount transferred by a resident company for the benefit of, on behalf of any person, in respect of any share in that company, to the extent that that transfer result in a reduction of CTC. CTC is a contributed tax capital. It's how much you contributed when you're buying the share. Whether the amount is transferred by way of distribution of a consideration for the repurchase of its own shares. So to refer, but of course, to the act, you don't have to worry about that. But now, you should know that the principles for establishing whether distribution by foreign company is a foreign dividend or foreign return of capital also are different. You also need to look at those things. First of all, dividend or return of capital, we need to know the common direct tax treatment as a dividend or CTC. That's a see. Is the dividend or CTC? Is it a distribution? Is there a reduction to the contributed tax capital? You ask yourself a question. If that's the case, it's not a dividend. Is that not the case? It's a dividend. Foreign dividend or foreign return of capital. So look to the tax value of country for residents. If there is no tax law, the common then law of the country of incorporation. In that case, it's a foreign company. Capital gains tax on common distribution. So this deals with your paragraph 19, where they say capital loss disregarded on sale of shares in respect of liquidation. In case a company is liquidated or deregistered to the extent that does not exceed exempt dividends, then it will be disregarded. So let's go again. Paragraph 71 also, they state that introductory definition paragraph for the company distribution, they just say what a company distribution is. Your 75, it shows you the treatment of a company and the shareholders in relation to asset transferred as a distribution in specie. Your 76B, it deals with the treatment of shareholders in return of capital or foreign return of capital. Then you've got your 7.7, we deal with the distribution in liquidation or de-registration received by the holders. So your 7 then state that it gives the definition, of course, for the company, which distribution. Then your 75, so the actual state that an asset distributed by the company who disposed the asset to shareholders on the date of distribution at market value. That's very important. The shareholders who acquired the asset deemed expenditure in terms of paragraph 20 at market value. So the expenditure to those shareholders, because remember, if you are acquiring the asset at market value, your deemed expenditure, you are deemed to have acquired that asset at market value. That's your para 20 of what? Of a check. So paragraph 6b then actually state that to the extent that the company distribution qualifies as a return of capital, the holder of shares is liable for CGT on the distribution, if not a return of capital as a dividend. So you need to know in this case, is it a return of capital as a dividend, or that's not the case? Then someone might be liable for CGT. CGT, which is the capital gains tax. So let's talk about this one. Default rule. So where a return of capital is received after 1st April and prior to disposal of the shares, then the holder of shares must reduce the base cost of shares by the amount of that cash on or the market value. So this is very clear. If, for example, now I was having a lot of shares, 100,000 shares. So it means the base cost of those shares was 100,000. But now all of a sudden, there is a CTC that came back to me. There is a reduction. So it means my base cost now of these shares needs to be reduced. Say, for example, I acquired these shares for 100,000, but now I just received CTC of 100,000. The base cost must also what? Reduce. So that when I sell these shares in the future, I'll actually be able to have, there will be more capital gains because I've already got some reduction. So is under equal to the cash received or market value in asset. In case it's an asset, it's a market value, but in case it's a capital, then what will reduce that base cost will be the cash received or maybe the market value. If the amount, of course, exceeds the base cost in that case, then we'll have to deal with capital gains tax. If it's an individual, it's 40% inclusion, 80% in case the company. So what happens on a company distribution? You also 7.7 state that a shareholder of a company being liquidated, if this is where the company now is coming to an end, or deregistered, must be treated as having disposed of his shares on the earlier of the date of distribution or deregistration. Guys, please mute yourself. Guys, what is this? What is this now? Don't get up, please now. Mute yourself now. Okay. Okay, so a shareholder of a company being liquidated or deregistered must be treated as having disposed of his shares on the earlier of the date of dissolution, or in the case of liquidation, where the liquidator, a person that's actually involved and deals with that liquidation, declares in writing that there are no reasonable grounds to believe that the shareholder will receive any further distribution. So in that case, then you can see it's a loss already. If they will not get any distribution, they are deemed to have disposed that. So where a return of capital is received by accrued to that holder of share after the above dates, the return of capital must be treated as capital gain for the holder in that year of assessment. This is also one of the important key things here. Okay. So distribution example, we've got an example here. So we talk about 39. We log any loss on the disposal of asset to a collected person. So which means that the loss can only be set to against a capital gain in subsequent years of assessment in that case. So we've got PTY Ltd had issued 100 ordinary shares, of which Tim owns 80% and John owns 20%. Okay. So these guys also owns shares in YPTY Ltd, an unconnected company, as well as a land and building. Sorry, the YPTY Ltd shares have a market value of 108,000 and a base cost of 210,000. The base cost is actually more than the market value. The land and building have a market value of 30,000 and the base cost of 10,000. So B distribute the shares to Tim and the land and building to John. So remember here what happens that we've got B actually has 100%, 80 shares in issue. 80 are owned by Tim. Then out of that, 20 are owned by John. Now B owns, okay? B owns shares in Y Ltd, which is unconnected. And also they also own land and building. So what happens in this case? Now they distribute shares to Tim and land to building to John. So both distribution come partly from profits and partly from shares. Now required determine the CGT consequences of B Ltd. So in this case, you've got to know B will make a loss in that case. What happens? So you need to remember one thing in this case, the market value of shares was what? The market value of shares was 180,000, but the base cost was 210. So there's a loss of 10,000 on the distribution of shares to him. And the capital gains of 20,000 distribution of that of land to John. So what does this mean? Because they've land in that case had the market value of what? Of 30,000 and the base cost of 10,000. So as you can see, so the 30,000 will be clocked in terms of paragraph 39, meaning which team is connected to B. What does it mean? Because B Ltd, team is connected to B because B Ltd, he owns shares in B Ltd. And by virtue of this shareholders in this company, he is actually connected to that. It's also a shareholder. So it will be clocked, meaning which it will only be allowed next year. 75P. So Mr. P actually holds all the shares in company D, and the base cost of shares acquired on first was 200. So the company D made a distribution on 1st April to Mr. P, and Mr. did not dispose of the shares. So required, what are the CGT consequences for the amount? So we've got 170 or 230. But let's see, in this case, it was actually 120, the shares they acquired. So note paragraph 76 then actual state that does not apply to distribution takes place after. So this distribution actually takes place after 1st October. So if the distribution is 100, the base cost will be reduced to 80. Let's see, what does this mean? So if the distribution is at 170, that's a distribution. The base cost of asset will be reduced to 30. If it is 230, a capital gain will arise. So why a capital gain? Because remember, he only owns 200, a value of 200,000 in these shares, but now he's getting what? 230. So it means there's a capital gain implications in this regard. Then why do we have a reduction of 30? In this case, the base cost, because he owns 100 and it will be reduced to 230 because he owns shares of 200,000, but he's received back some 170. Thank you very much, guys, for attending the session. Someone once said there is no such thing as a good tax. Yes. All right, guys, I see your hand. Okay. Just recording first, then we entertain the questions.